Index investing or passive investing has grown more popular with investors. Even Warren Buffett touts the benefits of owning an entire index like the S&P 500 over the long term. An example of an index tracking ETF is BMO's S&P 500 Index ETF. It's the largest ETF in Canada that tracks this well-recognized and popular index. It provides exposure to the returns of the market cap weighted S&P 500 index at a low cost with a management fee of just 0.08%. This broad market ETF makes for an efficient building block in a portfolio, saving you time and effort while mitigating single stock risk. If you're looking for exposure to the largest and most liquid public companies in the United States, this ETF delivers an easy-to-use solution and instant diversification. Commissions and management fees and expenses all may be associated with investments in exchange-traded funds. Please read the ETF facts or prospectus of the BMO ETFs before investing.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Hello, does this work?
Before we get started here, just again want to thank everybody for coming out. Super humbling to fill a room here, and yeah, we're super focused on obviously building the community here, which I think is what we've built over the last couple of years. Yeah, so thanks again for everyone for coming out.
Check. Check.
And for Keith, it's past your bedtime, buddy.
It is a bit late. I have a question though first. Who here is from Toronto? GTA, hands up.
Ooh, lots of Torontonians.
Okay, how do you deal with this traffic? This is horrible. So I live in Halifax, and I think it took us an hour and a half today to come from the Union Station area to here. I got to go from Halifax to PEI in that time, in rush hour. So it's, anyway, you guys deserve
A metro.
something.
They deserve a metro. A real metro.
Well, that'll be an infrastructure.
That's an infrastructure project I could get behind instead of these dumb bike paths that no one uses for 6 months of the year. As a biker, I'm allowed to say that I'm a biker. So, anyway, go ahead.
Rich, well, how you doing, buddy?
Oh yeah, good.
Late night last night, Rich.
Yeah, I got in the sauce. It was bad. I embarrassed myself in front of my colleagues. No, it was all right. It was good. We went to a very fancy restaurant that Keith picked out. I should not have had the cognac or the martini or the second glass of wine, but it was really fun and it was good. And
I think at one, the night was getting a bit funny when Rich and I both had one end of the king crab leg up trying to eat it.
Yeah, that's right.
But okay, what do you got?
That one's staying off social media. Yeah.
Who's staying off social media?
But, well,
Me. No.
that picture is.
Oh yeah, that one's gonna stay off social media. Yeah, that's right. I know. Otherwise, I'm good, man. No dates to speak of. But yeah, tell us.
Anyways, welcome back to Loonie Hour, episode 112. As always, joined by the three amigos, of course, Keith Dicker, Ice Cap, Rich. I don't like your
PGM Global.
Yeah, let's not talk about that right now. But no, anyways, I think we have to start this week off with bank earnings. We're here in the financial center of Canada, and we had a whole host of Canadian banks coming out this week. Keith, you've been following them pretty closely. Interesting to see how some of them are sort of tweaking their financials to get the markets to see what they want to see. So I don't know if you want to unpack that, but you had RBC beat, CIBC beat, TD missed, Scotia missed, but the big story is really just the loan loss provisions. It pretty much ramping up across the board. Other than, ironically enough, was CIBC. They beat, but they lowered their expected loan loss provisions. So
It's funny when we do these events, we book the night like weeks. I like to say months ahead, but we're not that organized. So a few weeks ahead. And sometimes you just don't know what's going to come out. Are you going to have any material to talk about? But we were very lucky. So today we had the Canadian GDP number. Bank earnings were coming out. A lot of U.S. data. And then we had, what else was the big?
Well, there's COP. Well, we promised
have
not to talk about
over
that.
in Dubai as well. So we had lots of things to talk about. So we're going to do bank earnings first? That's where you want to go? Or?
yeah, I want to go with bank earnings. I just asked you, wake up.
Okay. So I think everyone. Has anyone here never watched or listened to the podcast before? Really? 10 push-ups for this. You're in for a treat tonight. If we had a T-shirt, we'd give you one. Except Rich kind of didn't.
I screwed up.
Yeah, you didn't get that done. But no, the reason I asked that because I think you would know, our style, what we look at, what we don't look at. So you heard the gentleman here on stage, 20 minutes, half an hour ago, and really sharp, and they look at things differently than how I look at them, and the same with Steve and Rich. So for us, we manage money for families, across the country and other countries around the world. But we're always looking for signs and signals for turning points. Because if there's no turning point, then it's not a lot to do. So I lived offshore in Bermuda for about 11, 12 years almost. And I was just sharing with someone earlier tonight from about 2003 to 2008, there was nothing happening in the investment world. Every day, markets were going up like that. That's good. That's good, Rich. That's good.
And Europe outperformed, by the way.
But a point is that if you have a good trend and it's good times, you don't need to do anything. You just sit back and enjoy it, and that's it. But what we like to look for is, hey, what trend has changed? And we don't want to get confused with daily noise and even weekly and monthly. So if you know our narrative, and you're listening for the first time here right now, in our view, we're at the end of this 40-year cycle where rates were continually going low, and they were deadline then for another decade, and now we're going up again. And what we like to look at, everyone feels there's a recession coming. Because I know we've been talking about it for quite some time. Not years, but episodes, I guess. Some people are saying, hey, it hasn't happened yet. Now, this morning, we're finally getting data to confirm that it is happening. So now it's, okay, it is happening. What is the next step? Is it going to be deep or shallow or not? But you also have to look for other signals besides the GDP number that comes out. And the banks are amazing. So with banks, you never listen to what they're saying, because they're always saying, hey, we're awesome. We make a lot of money, we beat estimates, and that kind of stuff. Instead, you look at what they're doing. And what are the two things they're doing these days?
Charging huge fees to take money out of the ATM.
Anyone
Mr.
else?
Freeland's getting rid of those.
Okay, so they're doing layoffs, and they're not significant. It's only a significant layoff if you lose your job, right? That's what we all think. But they are doing layoffs, and it's 2 or 3%, and you get redundancy built in. All of a sudden, this is going to cost us $400 million, but we'll save $800 million over the next 6 years. I'm just making up the numbers, of course. So you have that happening. And banks are amazing financial creatures, and that they don't like to lose money. They want to make money. They're levered entities. And in Canada, they have no competition. I know they don't like to hear that, but in reality, it's not a lot of competition. So they're in a great period where, hey, when times are good, they'll make money. But now all of a sudden, we're starting to see they are preparing for the recession. Because when recessions happens, there are job losses, and then people can't pay back, debt. So this loan loss provisioning accounting metric that we've been watching now for a while is now really starting to ramp up. So I think that's what you were leading with today, right, Steve?
But wait a second, banks are also selling off, we've talked about this before, banks are also selling off or divesting from certain parts of their business. They sold some of their auto loan book, and they sold their RV book, I think. I can't remember which one of them. We talked about that a couple weeks ago, but that's also what they're doing. So.
Yeah, well, looking at an article here, TD Bank, obviously, again, increasing loan loss provisions, cutting thousands of jobs. So kind of the two indicators, Canada's second largest bank. I think the other thing to unpack from that, and I'm not sure if, I'm sure Ron's the guy to talk to on this in the house here, but is seeing, the negative amortizations across all these banks is actually starting to decline, right? So the percentage of the book that is negative amortizing is actually slowly starting to shrink, going from 20% down to 16%. So it's, again, still a really high number, but the dynamic there is basically what's happening is a lot of Canadians are panicking and saying, okay, this is a problem, I need to fix it, and rolling into a fixed term mortgage, right? So they're rolling out of what would have been during the top of the bull market, during the depths of the pandemic, and late 2021, early 2022, you took a variable rate mortgage of 1.2, 1.3%. It's now negative amortizing, and so you're saying, okay, well, I'll convert to a 3-year fixed now, or a 4-year fixed, whatever's left on my term, and I'll lock in at, today it's 5.5, 5.6, 5.7, and so like you're now locking in a higher borrowing cost for the next 3-4 years. And then
is that good? Is that good or bad?
Well, but on top of that, right? On top of that, so maybe some people aren't doing that, and they're choosing to stick with their variable, right? But what you're seeing is some of these people are taking excess savings, excess cash, and deploying it on top of their mortgage to pay that down and get it back sort of in line with their amortization schedule. So what I'm saying is ultimately you're taking spare cash that could have been deployed at, the Loonie Hour, or, your favorite restaurant, or your at the hockey game, and you're taking that and you're putting down to service your debt. So I think that's kind of happening. You can see that happening basically in the numbers. That's what it's telling you.
They did that in Australia too. So in Australia, they are basically dominated by variable rate mortgages. There's a bunch of countries we've talked about, but it's worth going over it again for the one person who doesn't like the Loonie Hour. But North Korea, not North Korea. That's cute. South Korea, UK, New Zealand, Australia, Canada, a bunch of these sort of developed, rich markets, their mortgage markets are tied to that front end of the curve. And so they're feeling the pain in the same way many Canadians are, and we'll get to that in a second. But in Australia, basically, I think at one point it was like 90% of all mortgages are variable, and people are locking. They're basically doing sort of the opposite of what you really should do, which is instead of locking in low, they're locking in high, and that's what you're sort of alluding to, I guess.
Well, I think we're going to get to that because it brings up the question of the future of interest rates, which again is a conversation for a little bit later on the show. But to kind of take this whole picture and put it together is, again, banks provisioning for higher credit losses, cutting thousands of jobs, people now starting to suffocate under these higher interest rates and locking in at higher fixed rate mortgages, less cash in the economy. So you look at the GDP numbers that came out, I think it was today.
Yeah.
GDP fell at an annualized pace of 1.1.
Oh, we're not finished with the loan loss provisioning.
Oh.
We got to hit with the number, because the numbers are pretty fun to look at. So if you're not aware...
We don't rehearse
Your
this.
show, buddy.
I was a lot more fun last night. But for people, if you're not aware of it, a bank will lend out a lot of money for a loan, and then there's always a probability someone will not be able to pay it back. So from an accounting perspective, they have to put aside a little bit as a bad loan every quarter. And it doesn't mean that it's going to be bad, but they're trying to account for. It's a way to smooth your earnings all the time. And then, so when the economy is getting slower, or they might lose their jobs and stuff, obviously, or as Steve just shared with us, maybe they're locking in for higher rates and mortgages. That means there's less money to spend elsewhere. But they have to start allocating more, increasingly more and more. So what we like to look at is, first of all, what is the history? So you look at each bank, and all this information, you can find it online. And so I like to look at what were they provisioning, say 5 years ago and 10 years ago, and then you look at what they're doing today. So the economy today is a lot bigger today than it was 10 years ago, right, Rich?
Well, sort of, but carry on.
Yeah, it is. But the provisioning they have is not really increased because of the size of the population and the economy, because in general you should have more losses coming up. But again, this is not investment advice. So I'm going to go through the banks and just get an idea of how much it's increased. So we'll start with RBC first. A year ago, they put aside 380.
I get shit for writing lots of lists.
Look at him,
380.
Look at him squinting.
Go for it.
What?
I get shit for writing lists, and you're doing the same thing I do.
I know. It was the Happy Days episode. You
All
had
right, carry on.
27 items.
We're waiting.
Okay, but RBC a year ago, about 380 million. Today, it's 720 million. So it's more than. Has it doubled, Rich?
I think that's doubled.
It's almost a double, right? And then it's higher, of course, than the previous quarter. So they're allocating more and more and more for potential bad loans. And that's a great signal because it's consistent. Like, it's not going like that. CRBC, we'll come back to that one. What was the Sesame Street song? One of these things are not like the other. Do you guys remember that? Anyone know what Sesame Street is?
I'm too young.
Yeah, one lady, there she is. She's raising her hand. We'll come back to CRBC. Scotiabank, they were at $500 million a year ago. Last quarter at $800 million. And I think Ron referenced Scotiabank earlier, didn't he? I think with this current number, it's $1.2 billion. So this enormous number. And you're saying, holy smokes, Scotiabank, they must have enormous exposure, to the, to the lending world. But also, you have to understand, Scotiabank, they have a new CEO. And it's like, if you become the new coach of a professional sporting team, like football, right? You go in, what do? You clear out all the old coaches and players who aren't productive and all that stuff. So it's likely that they really padded their loan provisioning number today. Because, just getting all the kitchen sink stuff thrown in. But still, huge number, TD Bank, 600 a year ago, almost 900 this year. Like another big increase. Bank of Montreal, they'll come out tomorrow, and they're going in the same direction. And then we have CIBC. So they had $400 million a year ago, $700 million last quarter. Anyone know what they had for this quarter? So 400, 700, any guess? 500. Get down like that, right?
They have really great credit adjusters
I
or
think
underwriters. They have a really great underwriting team. I'm sure
Absolutely. They can assess credit better than anyone.
Everybody.
Yep. This is my last thing I'll say. The likely reason they've done that, because banks are able to...
Not just banks.
I don't think manipulate is the correct word. They can smooth their earnings, but when you have less money in your loan loss provisioning, it means it's less of an expense on your income statement, so it means you have more earnings. So the CIBC number is really weird, and RBC had a negative number about 2 years ago, and I thought that was really weird at the time, and that got turned around. But the bottom line is, as we go into the discussion about Canada and the economy and where it's going and everything, the banks are screaming. Things are getting, a bit precarious out there, and they're preparing for it, which is good for the banks. But it's giving us a really big signal here, because it could really go into something else.
Hey there, have you been keeping up with Addy? It's not just your average platform, it's now Canada's largest real estate crowdfunding sensation. I'm a proud member, and let me tell you, it's a game changer. I use Addy to invest in top-notch institutional commercial grade real estate, not just in Canada, but in the good old US of A. Get this, Addy has enabled a whopping 38 properties onto the platform. The best part, everyone, yes everyone, from all corners of Canada can now jump in on the action. But that's not all. Real estate investing with Addy opens the door to a world of benefits, passive income, capital appreciation, mortgage paydown. So what are you waiting for? Join the Addy community and unlock potential real estate investing. Head over to addyinvest.ca and use promo code Loonie Hour. That's addyinvest.ca, promo code Loonie Hour.
I mean, I think you see that just like in the residential mortgage space, right? Which is like, I felt like during the depths of the pandemic, the housing market was raging hot. These banks were tripping over themselves to acquire borrowers, right? It was like, oh, well, we can beat that rate. We'll undercut that. We'll trim this. And they were doing anything to get the client. And today it's kind of like, here's your rate. If you don't like it, you can move to the next guy. And, we're seeing obviously the decline now in bond yields, and you're not seeing banks advertise, more aggressive mortgage rates. You got to go up the chain of command. You got to ask, got to, twist someone's hand to actually get that mortgage rate. So I think that's...
Well, we talked about that, it's the spread. And then that was one of the concerns of, and that's what, when we see the mortgage market, when we see the government bond market, what's a 5-year bond yield, which you always tell us about, and that's exactly what we're seeing, the spread actually widen between the mortgage that you're basically able to get and the government bond yield. Because I think we're, 40 or 50 basis points off that high. I think, would you say the bond market's having one of the best years?
We'll get to that.
Okay, sorry.
You guys are just ruining this whole show. But, Keith, before you rudely interrupted me, we've got this credit-based economy, which in Canada is very credit-based. Yeah. And now that people are not really borrowing, that seemingly now is being reflected in our economic growth. So Canada's Q3 numbers, which came out today, decline at annualized pace of negative 1.1% in Q3. The expectation from the Bank of Canada for their forecast was growth growth of 0.8. So we got negative 1.1. The Bank of Canada's forecast is 0.8. Now we did have what was it? Was it Q2? They had a Q2 revision. It was it was actually like a pretty big revision. So it's like, again, I kind of wonder like the StatsCan numbers of,
Oh God.
like who's
GDP. Calculating GDP is hard.
that's a pretty big revision.
It is a big revision. It is a big revision.
So technically now, we
not-
were technically, like last episode, we were in a recession.
No, we weren't. Not quite.
Technically,
No.
it was back-to-back quarters of negative GDP.
No. Anyways.
Well, unless you change the definition of a recession, which I
But
think
we're out of it now
I
because
think the
Q2
Americans
got
tried
revised.
to do that last year, didn't they?
And they were right, by the way. They were right. You know, you can be slimy and right at the same time. No, you need some kind of unemployment growth, or you need a contraction in your labor market along with the contraction in the economy, and incidentally, we're gonna get. Are we allowed to get to that now?
Yeah, you can go.
Here's the deal. The Canadian economy is slowing, and then it was basically treading water or at zero for 6 months or 2 quarters. That's where you get that recession talk that people love to talk about. Whenever any economic data comes out, it's for the most recent period, and as time goes on, you get a better picture of what really happened, because there's a lot of guessing or estimating, whichever one you want to use, to come up with the number. And then when you get revisions, sometimes they can be quite different than what they originally reported. So today, the original number for Q2, it got revised a lot higher, right? So because in GDP, by the way, it's not measured year over year, it's quarter over quarter. And so because the Q2 number all of a sudden went up so high, by default, the Q3 number is now being measured from a higher base, and that's why it looked, really ugly. So if you smooth them them together, we're probably back to the same number. Yeah. However, instead of just having weak growth, it's clear now that we're coming like this in that direction. But what kind of slope is that, Rich?
A negative slope?
It's a slippery slope.
Oh, come on. How was anybody supposed to know that?
Who knew it was going to be slippery? Hands up.
Yeah,
there we go.
No, but I think, to me, whether or not we're in a recession or not, to me, that's a purely academic. That's like just navel gazing nonsense. I mean, what matters is, are people getting wealthier per capita? This is something we were talking about a year ago. It's nice to see people catch up, but I think that's really the most important thing. And now we've had per capita GDP is contracting. We know that retail sales.
That one, 7 straight quarters.
Excuse me.
7 straight quarters of declining real GDP per capita.
Yeah.
So I think that is ultimately being reflected in the sentiment.
Yeah, sure.
Today,
Consumer confidence.
in the polls and the sentiment. I just think you can see. I think people just feel like I think the general population feels like they're falling behind.
Yeah, well, they are. I think it's also really important to note that this is not always the case. So I was writing a note, actually, just so happened to coincide with us doing this tonight. And basically the premise is that our recession, and I think that we're either in one or not, it doesn't really matter. The point is that it's going to be a different type of recession. But before we get to the recession, I think it's important to know for Canadians that from 1994 to 2015-16, depending, our GDP per capita rose in lockstep with America. They started at a higher point, fine, so maybe they will end up at that point richer. But it's actually incredible. The chart is. It's lockstep. Like literally, if you rebase it to 100, 2015, you're exactly the same number. So that's 20 years basically of growth, ups and downs, cycles, no cycles, what have you. In 2016, that broke. Partly because of the oil crash. So the oil fell. Our economy is very much dependent. We are a petrocurrency or a petroeconomy, despite what people might tell you. That's just not true. We are very much dependent on that, whether it's current account balance and currencies and whatever. The funds our welfare state. In 2016, we have a situation where the U.S. continued to go up, and Canada basically per capita now has basically been flat for almost 8 years. I'm ignoring the COVID dip because that's COVID, whatever, but you know what I'm saying? So it basically, we had 20 years of lockstep growth with America, and then at 2016, they went up and we invested in real estate. And
thank you for your service.
And what's also really important to note, though, is that in 2008, when America, in my view, was a depression, you heard it here first, the U.S. basically had a similar situation. We're dealing with what? So they had a huge run-up in household debt. house prices collapse. We all know, we've all watched The Big Short, which is a great movie, although Margin Call's better. But anyways, and you have a situation where basically they retrenched on their debt. Canada, again, did the opposite. Sorry, Steve, we plowed every extra dollar chasing. You guys are from Toronto. You guys know exactly what I'm talking about. We plowed every extra dollar we had and leveraged it into a housing market, which in my view is overvalued, but I've been wrong for a long time on that. The point really is now we have a situation where interest rates have gone up, and the Bank of Canada cannot cut interest rates. And in my view, there's two very glaring reasons why. But importantly, which is population growth through immigration and deficit spending, which the BOC admits that is basically contributing to inflation. So you've got a situation where you're stuck, and so that basically means that we're suffering what I think is going to be a balance sheet recession, which is instead of consuming or investing or saving, that marginal dollar that people get is being plowed into servicing their debt. And that's the game we're in. We're in that trouble. And so when you see this growth happen, it's like, that's why, Ron Butler.
So Steve, we talk about Rich and his lack of self-awareness sometimes. You're sitting in front of the real estate mafia in Toronto. What are you thinking?
Well, I'm thinking I should look for an exit.
Rich is making a good point, though. And for Rich, I think you were one of the first in the country to start talking about population growth and per capita data. And now I'm starting to see it now in a lot of different places. So he does come up with some really good ideas frequently. It's not every now and then. But you are onto a very important topic. Because again, the way I look at the GDP per capita and the population growth, it's taking increasingly more and more people to produce the exact same amount of GDP.
But that's what's so crazy about it, because all things equal, this is why being in a recession, not a recession is bullshit. Basically, we all know that we're in one, and we know this because our population growth is over 3, 2.5, whatever number you want, and yet real GDP is flat. So that tells you everything you sort of need to know about the state of our economy. And to me, when people figure out that they can't move here, and who knows what happens if our population stops rising, to the pace. What's going to happen to our economy? We'll see. But yeah, so I think that's...
So just to unpack that a little bit further, because I think that brings up like an interesting dynamic that is playing out today, which is like everybody just assumes that population growth is going to continue unabated. Right. And I do worry that you're running into now these social frictions. I think we're seeing it playing out in large parts of Europe right now. I mean, Ireland's a glaring example of the sentiment that is turning sort of against immigration. Canada clearly needs immigration, so no one's sitting on stage here and saying, oh, you shouldn't have immigration. We should, but the problem is when you have the infrastructure issues that we have and the housing issues, that you're creating angst, you're creating
Toronto transportation systems.
No, but an hour 20 to get here.
But there's some real impacts, right? So this is why this idea that the bank we talk about this is why this idea that the Bank of Canada, there's rate cuts priced in. Are we allowed to talk about that yet?
We're getting there.
Not yet.
Okay, fine. All right. Well, then over to you then.
So this is
I wasn't done.
Well,
because I'm looking at this, we're going to get the jobs numbers tomorrow, correct? I think in Canada, the jobs numbers. So StatsCan's going to pick the random number generator, is going to spit something out tomorrow. So we're going to see where that comes in. But
It'll be positive.
But what we are seeing, right, is jobs are we're adding jobs each month, but we're adding more people than jobs. And so the unemployment rate is going up. And so that's what I'm saying. So how are you going to continue to get 1 million people a year, but you don't have enough jobs for the existing.
Right.
So that's where I'm saying is I think you do run into a situation where you don't add 1 million people, maybe you add.
But that's what's so fascinating about it. Participation rates. So there's unemployment rate. So it's people in the labor force looking for jobs and whether or not they are employed or not employed. And then there's participation rate, which is are you participating in the act of trying to find a job? And our participation rate for people aged 15 to 64 is at an all-time high. And which is the unemployment rate is starting to creep higher, right? It's historically low, 5.7, which is very, 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 very low historically. It is rising, and our participation rate is rising, and yet you showed me a chart today, Keith, of retail sales. And
Per capita.
but we know that retail sales, but not even per capita, it's flat. So all these, it's amazing the degree that it's. The point is that what matters is productivity growth. It's like what that individual is bringing, or another way to measure that is that per capita GDP, and that we know that that's falling. Meanwhile, just the U.S. Just sorry to finish the story and pass it on to you, is that the U.S. per capita GDP went like that. Their research and development spending as a percentage of GDP is in the mid 3s. Just to give you some context, South Korea, Israel in the 5s. You know, you have U.S. in the 3. You have Germany like a little bit lower than that, and then you have Canada. I'm thinking the scale goes like that, and Canada basically at 1.5% of GDP, and we just are not productive. And so, how do we fix that? Well, it's a conversation for another podcast.
What's happening with the CFIB?
Oh yeah.
I was wanted to unpack that a little bit.
Yeah, well, just like we talk about other indicators.
This is Rich's new pickup line.
So the CFIB, which stands for Canadian Federation of Independent Businesses, and we talk about diffusion indexes, and which are important for understanding what's going on in the economy, and they ask questions to their members. There's, we talked about diffusion index, the ISM, which is the Institute of Supply Management, that's in the US. They do a PMI. There's S&P Global Market, with an I, is another company. Anyway, CFIB does it, and their number just fell to
45.6.
45.6. And they ask questions of their members.
So 50 is growth. So anything under 50 is contractionary. So 45.6.
That's a diffusion index. Anyway, so what's also important is that they ask you: are you expanding your workforce? Are you planning on capex? What is the biggest issue for lack of growth? Is it demand? Is it foreign demand? Are you exporting more? Are you importing more? Are prices going higher? Prices going low? Whatever. They put that together in a diffusion index, and it's below 50 and falling, which is obviously quite stark. We know consumer confidence is falling. But the thing I wanted to point out in that was that they talk about wage pressures, which have been quite high, and talk about price pressures. And what I thought was really interesting, and this is alluding maybe to our later conversation, is that wage pressures are falling, okay, but price pressures are actually stabilizing and remaining quite high. And that's the sort of the pickle that we're in.
Why don't we do our own survey here? Yeah? It could be a diffusion index in your mind for the rest of us. But let's do it. And again, there's no right or wrong answer. So raise your hand if you feel the economy, whatever your head is in your body, if we're working and stuff, if what you're seeing that there's still strong growth taking place. So raise your hand if there's good growth.
Come on, really?
I want that guy's business,
no,
right?
I don't.
Okay.
Okay. Now, next.
Man, there's a lot of realtors in here.
Okay, so next then, let's raise your hand if you feel growth it's flattish. It's kind of what we just saw in the GDP number. It's just treading along. Things aren't awesome and things aren't bad.
Don't be shy. Okay, a lot of flat.
How many hands?
I don't know. I can't count that high.
Okay, and the third one is you're seeing things really slowing down right now. Hands up for that. Okay. Keep your hands up if you're in the real estate business. Okay.
I mean, that is a decent market gauge.
But that's probably in line, though, for the flattish growth to down. It's kind of what we're seeing. I think we need to.
Yeah, I mean that gets into the interest rate play, right? I mean, I mean, you guys got the Bloomberg terminal, but markets are pricing in. How many cuts from the BOC? And so it's interesting because you go on, I know Twitter's, can be a bit of a cesspool, but you go on Twitter and everyone's like, you can't cut, it's never going to happen. The markets are pricing in the BOC to cut. Again, whether or not that happens is anyone's guess, but clearly, to your point, I think there's a balance sheet recession. I'd argue that we're already in a recession, 7 quarters of negative GDP, on a per capita basis. So to me, cuts seem very logical. But I'm the real estate guy, so maybe I'm a little bit by. What are the markets pricing in?
So we got a Twinkie bet coming up soon. I know that's going to happen. So again, for us, we're market guys, and we never want to look at we never say, hey, the market should be doing this instead, or policymakers should be doing that. You want to listen and understand, okay, what is the market telling you? It's for the signal, the indicator. So we're going to go through 5 central banks. We'll start with the Canadians.
All 5?
4 of the 5. We'll leave Japan out then, right? But they're all going the same direction. So every single central bank right now, so the Canadians, the Americans, the Europeans, and the Brits, they're all at basically 5%, right? That's what they are. The markets right now by June of next year, the markets now are pricing in almost a 50 basis points cut for everyone, right? So by next June. And then by the end of the year, it's 100 basis points for everyone.
Can you not read your notes?
I have my notes right here.
Needs a flashlight.
Yeah. So this is not great news, by the way. So everyone in the real estate world and variable mortgage, what you're hearing now is that, hey, the Bank of Canada, they're going to cut rates by 100 basis points. It's like, great, it's good. Again, this is our view, right? And we're right sometimes, but this tells me if the Bank of Canada is going to be cutting rates by 100 basis points over the next year, it means the economy is doing this, right? That's not what you want. You want no rate cuts over the next year and no more hikes. That means the economy is still solid and the global economy, we're sorting things out. But right now, the markets are telling us that they're expecting bad news coming up over the next 6 to 12 months.
These are famous last words, but I think the market's wrong. I don't think there'll be any cuts in the U.S. I think the U.S. Is doing okay. Their households are not at all impacted by short-term interest rates. The refinancing wall that is coming in 25 is exactly that. It's coming in 25. Got data like the Chicago PMI that came out, another diffusion index, that blew out. You definitely have some weakness in sort of the capex numbers from the regional central banks. That's negative, but in general, it's ticking along, and so I think that's in the U.S. I think in Canada, you can cry for the cuts all you want, but this is the problem we're in. You've got 2 very important impulses that are inflationary, deficits, spending, which that's according to the Bank of Canada, by the way. Those are not my words, and population growth. That's just straightforward, And so I'm sure the Bank of Canada wants to cut interest rates, but they can't. And I don't think they can until they absolutely see a really significant jump in unemployment where they're basically forced to, or there's a fall in inflation pressures. The problem is that one of the key factors of the core CPI basket and the headline CPI basket is shelter, your favorite component. And guess what's the biggest part of shelter? One of the biggest parts of shelter is rent. And guess what just made a 40-year high? Rent.
I think anecdotally, I think we're starting to see, it's also seasonal. Like anecdotally, rents have, in my opinion, have peaked out, at least for the season.
Yeah, fair enough.
And as you guys start to get that unemployment rate higher, you have to imagine that it's a bit of a headwind for the rental market.
I know, but
that's lags, right? Because StatsCan's like 12 months behind the actual market.
Well, be that as it may, you have inflation is still above target. So Canada has a 2% target with a 1% either side range, and we're still in the 3s.
Do you actually think that guy's going to wait till he gets to 2?
I think the idea that central banks are preemptive.
I think we just let him keep going.
No, well, you had your chance at the beginning, buddy. We didn't say anything, so no. But I'm serious. But I don't think central bankers are preemptive. Do you, Keith?
Well, we talk about this quite a bit. I think we have a very similar view in that. I suspect the world we're going towards is that I think the economy is going to really struggle. We're going for a real grind, but inflation can stay high. And that if there's no crisis, then the central banks will likely not be doing all these cuts that's being priced in, because and they have to watch the Americans first, by the way. So if you move lockstep with the Americans, you'll be okay on a relative basis. But I can see the economy coming up where it was this classic stagflationary environment. Growth is really sluggish, but I think we're headed into some kind of potentially we're headed in towards a commodity boom. So a global shortage in commodities across a number of spaces. And, like these bottoms, they could take 12 months to play out and things like that. And as you know, like we've been going to these positions now for the last year as well in preparing for it. But if we get a commodity supply tightening or whatever you want to call it, that's inflationary. It doesn't matter what growth is doing. And then you put any kind of conflict on top of it. It could create this environment where the banks, maybe they don't have to, or they can't cut. I think they're in a tough spot.
What probability do you realistically assess to that? Because my pushback is if you're in the camp that, hey, a recession's coming, I agree with you. I think it's maybe harder than soft. How much of that is just demand killing? That like, yeah, you got some supply challenges on the commodity side, but your demand is like shit.
I think a year from now, when we're back somewhere around here.
Back at the dawn.
Back at the dawn. I think the economy, monetary policy, fiscal policy is going to blow everyone away. It's going to be completely different than what the expectations are right now. Because I remember markets move in huge swings. So to go from a world where we went from 0 to 5. What's interesting with that? So we had people would say like over 18 months we had the most severe increase or the most rapid increase in rates in global history. 0 to 5, everyone did it. But they neglect to say that for 10 years before that, or 12 years, we had the most bizarre monetary policies, since Earth was created. And again, this is what we talk about with markets. And the real estate boom in Canada and everywhere else, it was created because central banks, they went to zero rates, negative rates, and they did quantitative easing. I like to say they suppressed the global yield curve because it sounds cool, right? Sounds cool. But what they did, though, they prevented price discovery in the bond market. So I don't mean it was zero, but nobody really knew what the price of debt should really be, and it enabled households to borrow like crazy. So when you said the deviation for the per capita GDP for Canada, it's a bit odd, right, when it started taking place. But households borrowing crazy, governments have been borrowing crazy, and now what do they say, Steve? The bill. Remember last night you paid the bill when it came due?
Uh-oh.
He did, didn't he?
Did you?
Last night?
Oh, yeah, last night
you paid the bill.
No, you did.
Yeah. But I think this bill is coming due, and it's going to create something we haven't been aware of.
Well, yeah.
And then the other thing, and this ain't good news, so do put your hands over your ears. Canada's had 4 recessions, right, over the last 40 years. So do you know which one's Rich? I love how Rich wasn't with us a couple of weeks ago, and it was a grind, wasn't it? It was a grind of a show. I like having him back.
I'll take I'll take all the flattery you could send my way.
It was good. It was like a backhanded compliment
I know,
to the way, right?
It's okay.
Yeah.
Are you going to guess? I'll guess.
I can guess, yeah. Well, 1994.
Go. 3, 2, 1, go.
Oh, 1994.
Okay, let's which we had 82, 90, 08, 09, and then 2020, call it that. Each of these recessions were really caused by global events that were taking place, and Canada was involved in with everyone else, and we dealt with it. My concern today is that Canada has never really experienced its own national economic crisis yet, and it doesn't mean it has to happen. It just means that the probability of it happening is higher than at any point in time. So you need, again, like we manage money, so we have insurance, to protect us and just in case these things happen. And I think the epicenter will be the GTA. It's going to be in the lending market. And
Get your tomatoes out.
They're all coming. And again, it doesn't mean it has to happen, but the conditions are perfect. Like you couldn't create this any better.
It is now. Is it my turn to talk about the balance sheet recession then?
It's perfect. Yeah, it's absolutely perfect.
So I think that what is different this time, and that's like a classic euphemism and everybody in my business is always saying it's not different this time, or it is different this time, and it is different this time, because when you had those recessions, debt to GDP levels were far, far lower. And even though interest rates were higher, that's the thing. That increase of 5% on debt to GDP levels of 50, it might be painful for some people, but it's not nearly as painful as when your debt to GDP. I think household debt to GDP is now 105%. And so why I think it'll be maybe unique to, not unique to Canada, because there's other countries that have had balance sheet recessions. And you're saying, what is a balance sheet recession? A balance sheet recession is sort of what it says on the tin. It's a function of your balance sheet, which is assets, liabilities, and then a sliver of equity that is constrained. And so your assets start to go down and your liabilities remain relatively fixed, and what that remainder is your equity. And that equity gets squeezed and squeezed and squeezed. And we know that this is, so you might have heard of something called negative equity, which has happened a lot in places like Las Vegas or Arizona or whatever in 2008, where people owed a lot more money than they owed on their house. That may or may not happen in Canada because people are relatively well capitalized, but what it does do is it hurts people's wealth effect. So people feel less wealthy because they have to meet their debt servicing burdens. And we know that those debt servicing burdens have gone up. Canada has the highest household debt service ratios ever. We have the highest debt to GDP and debt to disposable income at 177%. The only country with higher debt servicing ratio, according to the BIS, is Australia. That's another conversation. But so what we're saying is that as interest rates go up, people allocate less money to consumption, savings, and investment, and more money to paying down that debt. And that's a pernicious and often long-lasting kind of contraction in your economy.
But yeah, you're saying all this, and then you're saying the Bank of Canada is probably not going to cut next year.
That's right.
And I get to the point of, again, I just look at it through maybe like the real estate lens and the mortgage lens, which is by the end of this calendar year, less than 50% of Canadians will have seen any mortgage payment increase. So all that tightening is still coming through the pipeline, which I would argue is disinflationary.
Yeah, so that's one of the sort of the side effects of a balance sheet recession. You do have this you could argue that it's deflationary. It's what, for example, what happened in Japan. It was a long deflationary period. My point basically is these people are not going to be able to walk away from their houses. Interest rates are going up. And the idea that the Bank of Canada is going to cut interest rates from 5% to zero.
Definitely not. But yeah,
not going to happen. I mean, maybe it could happen. Fuck, who knows? But what I mean is, like, it's highly unlikely when you have inflation at higher, as Keith laid out. So
there was actually an interesting piece from David Rosenberg in the Financial Post, I think, this week. And again, people can have their views about him. I think he's a pretty well-respected individual. Yes. He's had some good calls. He's had some bad calls, but. He in his view, in his opinion, in his research, he runs a research firm. He thinks the Bank of Canada is going to have to cut 300 basis points to avoid a nasty recession. And I'm not saying that's going to happen. That's not my view.
No, I got you. Just smart guys.
But so. I think 50 basis points personally by next June. This seems reasonable.
I mean, we're used to thinking that we're in a normal cycle, right? So if it's a normal cycle that's coming up, we're going down, and we should get these rate cuts by the Bank of Canada and the Americans, everyone else. And is it 50 or 100 or 75? It doesn't really matter. It's the direction, that counts. That's in a normal cycle. Again, my concern that it becomes a super cycle, and it's something that you just have to be aware of. That it doesn't mean it has to happen, right? Because maybe we do go down to this, we get slower growth, across the whole country, and they cut rates, and population growth is still great, and that helps to solidify things. Nothing else blows up over with the Europeans, the Japanese, the Chinese, or the Americans. It's again, the trigger event for Canada can come from outside of Canada. That's why the world is so awesome, because you got to look at the whole world. You just can't look at it from Kitsilano and everything like that.
Yeah. So I got a question for you then on the bond market. So this month has been the best month for the global, not just Canada, the global bond market since 2008. Of course, you know what happened in 2008. So it's been the best month for the global bond market since 2008. Obviously, basically yields falling significantly. The volatility in the bond market over the last 18 months has been unbelievable. But how are you looking at that? Are you looking at that as like, I'd fade this rally? I mean, I guess it always comes down to like time horizons, but.
So with this, people know my view in the bond market. So, your toll is the safest low risk investment that you can make. So we just had this low risk, low volatile investment go up 5% in 1 month. Like, how is that a low risk investment? You like it because it went up 5%, but my point is that it also went down 25%.
More 50, way more than 25. Sorry.
Well, I'm just looking at in like
sorry.
a balanced kind of bond portfolio sort of. But again, like markets are not going to be linear. They're going to have these huge swings. We actually shorted the bond market last week. We added a small position. I think I mentioned that in the podcast. We did some trades. And I said I'll mention it after we're all done. So
that's a hot take right there.
It was what?
That's a hot take.
Yeah. And but we did a little bit of it because again we're going to get these ebbs and flows coming up, and
I think you should probably put an asterisk next to that I'm assuming it's a tactical trade.
Yeah. It's something like that you don't want to keep on for a long time, but if it goes as we expect it will go, and we've done this. I'll say 2 or 3 times over the last 2 years. You just take your shot at it when it's there and you do it. But our long-term view for long rates, and again, a lot of stuff doesn't reconcile. They say, wait a second, you said we're going to have a recession. If that happens, long rates, they go to zero and everything. I can see a world where longer rates continue to go higher. Again, because the world has shifted. We've gone from 20 down to 0, they kept everything there, and now the world is still trying to figure itself out when you have all this fiscal borrowing take place. So the irony is that next year, say we have central banks, they start to ease, they're providing stimulus to the economy again, at the exact same time when our governments, they've already maxed out on their fiscal deficits. Now they're clawing back. So the reason going from 0 to 5% for the central banks haven't worked out as well as everyone thought it would, because our government spent you can use it. What do you want?
The U.S. was at 8.4%.
No, we need a good analogy.
Oh,
they spent
drunken sailors.
That works.
Okay, here. Why don't we do this?
But wait, sorry, can I just jump in there before?
Okay.
I think what people don't realize is those interest rates, they're different on different ends of the curve. So the central banks control the front end of the curve. That short-term overnight is what they call it. In Canada, it's the overnight target rate. In the U.S., they worry about something slightly different. But there's other bond yields that are at the long end of the curve. You might have a 20-year bond, a 5-year bond, or 15, or whatever it is. And those are largely purchased and sold, and that's related to demand. And so when Keith says, you could mess around with the front end of the curve, but the longer end of the curve might stay elevated, is because that price is dictated by supply and demand. And what's supply? Supply is deficit spending and issuing that paper. And supply is, do you have enough people, you, me, whoever, buying that paper from the government when they issue it? And if we don't believe they're fiscally we don't believe them when they tell us that they're, what did he say, fiscally restrained or whatever? Anyway, you know what I mean? And
fiscally responsible.
Right, that's right. If we don't believe them and we think there's going to be loads and loads and loads of supply of this, whatever it is, housing, cars, in this case, paper.
We're the best in the G7.
No, we're not allowed to say that. Okay, enough with the G7.
And we get, our homework is graded every year by the credit agencies.
Yes, those very good credit agencies. But anyway, sorry, Steve, what's really important, people understand, those interest rates are supply and demand dynamics play on that. If you flood the market with supply, what happens to the price? So that's really important that people get that. Sorry. Now
apparently, JT was actually in Ajax today.
I don't know. Where is that? Is that the thing people use to clean their bathroom?
He's close by. He was talking about housing.
Oh, that's a city.
He's not here. I didn't see him. Did anyone see him?
I swear my mother uses that to clean. Anyway, never mind.
Just offended a lot of people in this room. So we're getting close to the end of the show here, but I'm kind of curious.
Oh, one more thing.
Don't worry, you got a few minutes.
Yeah. Credit spreads are incredibly tight again. So again, everything's not moving in the same direction. So if you look at credit spreads, it's telling you there's no recession coming. Everything is awesome, right? So again, markets could be coiled for something unpleasant, and you just get ready for it. So if we get, the next stage of the bond market that could melt would be corporate debt. Because no one's expecting a recession, credit spreads are so tight, and that's a perfect opportunity. I wanted to throw that in for you.
No, that's fair. I mean, I think it's just the biggest thing. I think is just figuring out time horizons, and clearly this is a very complicated. There's a lot of nuances here. There's a lot of things that could change. Inflation, deflation, interest rates. So there's a lot of things that we can't control. So to say where the market's going to be 6, 8, 12 months is always difficult. But I'll put you on the spot. Let's go to like the U.S. 10-year, which is the U.S. 10-year Treasury yield, which is highly, highly followed. If you were like a betting man, because I know you're like, hey, right now I'm short bonds, right? So you're taking the contrarian view right now. If you had to like guess, and hopefully no one holds them to this, but 12 months from now, where do you see the U.S. 10-year? So it hit five, a month ago? We're down to 4.3, so a 70 basis point move in a month is a huge swing. We're getting closer to a recession. We still have some supply stuff.
I think we'll be between, it's a wide range, but the lower number is the best one. I think between 4 and 7. We're already at 4.
That's way too high. A very low confidence interval, which is fair, by the way.
4 and 6 then.
Yeah, no, well, you stole my thing.
I mean, that's aggressive. That's aggressive.
Yeah. So there's different ways that you can. The way I would answer this very like nebulous question that hopefully people don't hold me to is the way I would say is like, how would you determine whether or not we're at fair value? And there's different ways to do this. One of the models I stole from some guy at the Fed, it was nominal GDP plus some kind of real GDP growth plus some inflation number. And if you get real GDP growth of 1 or 2% plus inflation of 3 or 4%, you're in this 4 to 5% range. And I think in
7.
What? No. No, I think you're in this 4 to 5 range, which just makes our answers sort of boring because they're similar. But to me, that's the way I come to that. I think inflation is going to be higher than people hope and expect, and I think growth will be okay-ish or bad, and then that's where you get to that number. So there you go.
It's a bold call. On a final note, while we're talking about central banks and what Tiff Macklem's going to do, you've been a very strong advocate of saying no to CBDC.
Oh, yeah.
And so we actually had a report from the Bank of Canada that came out. So they did like a survey and said, okay, let's ask Canadians what they think of CBDC. And I think, honestly, I can probably I'm like, what normal Canadian goes on like the Bank of Canada website and is like, yeah, today I'm going to say no to, I think it's probably like everyone that replied to that survey has to be like in this room.
I absolutely filled out that questionnaire.
So 86% of Canadians expressed, quote, strong criticisms of a digital dollar. So
we did it.
I'm very proud.
The bad news is the survey doesn't matter. They're still going to do it.
Well, I think it's important we just take a second to express why. No, a little bit. I mean, the point is just the main thing, and credit to the Bank of Canada, is that they actually were quite explicit in why people were worried, and it is this privacy thing. Because again, do not quote me. Go and Google the Bank of International Settlements, which is the central bank. Go and look up the general manager. He's a very interesting looking chap. And just type in what he said, and go check out what Christine Lagarde, who is the chair of the ECB, and see what she says. And the whole point of CBDCs is that they can literally program how your money is spent, where it's spent, how long that money exists, and forever. And so that to me is like, I know now I'm sounding like.
But he's got his tinfoil hat on, just like you.
To me,
they definitely won't let anyone spend $65 to go to the Loonie Hour event.
Well, I mean, but that's what's so crazy is that they're very explicit. They're very explicit. This is on their own website, in their own language, from the people who run these places, and they're telling you why they're interested in doing this and why they want to do it, which is to control but not just control, but it's also to prohibit certain types of spending, and you can figure out what the next path is there. And to me, that's why I'm really surprised that the Bank of Canada actually articulated that. So good for them.
I think that's a good place to wrap up. Say no to CBDC. Thank you so much for coming.